From the morning reading, the Qs break out of horizontal resistance and surge to new high. Spiders, diamonds, new all-time highs. Breadth strengthened compared to the prior session as advancers led 1812 to 1237 on the New York Stock Exchange and 1591 to 1243 on the Nasdaq. On the S&P 500 snapshot, back to rally mode. After the day before's breather, a fractional 0.11% decline, the S&P 500 moved back into rally mode. The index popped at the open, contracted a bit, and then rose to its 0.91% early afternoon high, and then drifted lower to a narrow trading range before its 0.65% gain at the bell, which is another record close. The S&P 500 has now risen almost 9% since the rally that began on Monday before the presidential election. There are two big questions in advance of tomorrow's market action, that would be today. Would the Fed announce a rate hike, and how will the market react to the decision, whichever way it goes? Time for rising rates. The Federal Reserve is about to increase its target rate, marking the second consecutive increase in its target rate. This is a rate cycle unlike any other, but if we take a look at other back-to-back increases, stocks tended to stumble a bit while commodities in general consistently rose. Something other than stock price movement is driving uncertainty, whether it's the looming FOMC decision or politics or whatever. The VIX fear gauge has decoupled from the index it's based on, the S&P 500, to its greatest extent since 2012. When stocks have been doing well and then something else starts to impact the VIX, it has consistently led to an increase in volatility going forward. Buy puts on bonds, calls on stocks. That's been the theme. The put-call ratio on 10-year treasuries jumped to 3.4, while on the stocks it dropped to 0.6, both among the most extreme in years. Breadth. This is the first time since July 19th of 1999 that the S&P 500 rose at least 0.5% to a 52-week high on 2 out of 3 days, and yet both the up issues and up volume ratios were below 65% on those days. That date happened to mark a multi-month peak. Energy stocks have joined financials. Both sectors are showing an extreme percentage of members trading at 52-week highs. In the December 2 report, we noted that if the percentage of stocks in the energy sector at a 52-week high reached 60%, it would be a serious warning sign of an overheated market. It reached 58% on Monday and should exceed that with the next session. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:11 a.m. Mountain Time, and I am recording this in preparation for the market day of December the 14th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and bounce into the morning report. Okay, at the time of this cut, the 4 broad-based U.S. indices were mixed, but all rotating around scratch, which is not untypical of the night action before an FOMC announcement. The S&P, Russell, and Dow futures were all just below scratch, and the Nasdaq futures were just above scratch. Crude oil down big, down 1.8%. Euro up about 0.25%. Bonds up about 0.2%, and gold up about 0.33%. China is down about 0.5%. Hong Kong right at scratch, as is Japan. Germany down about 0.25%, and the United Kingdom down just below scratch. In terms of macroeconomic reports for today of note in the United States, you have core retail sales, PPI, cap utilization rate, industrial production, and weekly crude oil inventories. And then, of course, the big one in the afternoon during market hours, FOMC economic projections, its statement, and the Fed funds rate, along with the press conference. So all of that could absolutely move the market in a big way. So we may see a bit of action first thing this morning, and then the market gets somewhat quiet as we await that decision this afternoon, which is at noon Mountain Time, if I remember correctly. Yeah, and then obviously we should get an inflection coming out of that, whatever the market digests as market moving. Okay, we had so much stuff on Wednesday, I didn't have time or space, I should say, for a Thursday, so we'll have to just skip that for today. Then in terms of current volatility, short-term VIX at 12.25, so a little higher than it's been of late. We've seen a little bit of a move in volatility. One of the morning authors mentioned that, but this is relatively minor and within the noise range of normal bull market. So just kind of keep that in mind. This is a very low short-term VIX and big-time relative purposes. Skew also benign. IV percentiles are also exceptionally low, though not quite as low as they were a few sessions ago. 11 for the S&P, 23 on the Russell, 13 on the NASDAQ, and 12 on the Dow. We did have a standard deviation move put in by one index yesterday, and that was the NASDAQ, with a positive 2 standard deviation move. So for an index that has been relatively the weakest, you have to kind of give it a little bit of respect for the kind of positive moves that have come in of late. Obviously, the Russell's been of a tear up until recent sessions, which it's then given back some of that. But you look at what's happened with the NASDAQ in, say, the last 7 trading sessions. A 1 standard deviation move, followed by a 2 standard deviation move, another 1 standard deviation move, and another 2 standard deviation move. So a lot of bullishness in the NASDAQ to finally get it up and over the hump. And let's go ahead and take a look at those charts. Let's go ahead and start today with the NASDAQ. And you see we finally got that move up above this area of resistance, and it was a big move with a 2 standard deviation move, and it was clearly above all this noisy area of resistance, so a clear move to break from horizontal resistance. So we now have all 4 index above that former area of resistance, so that's pretty notable for the bulls. And while we might expect, and look at this bullish action here, just almost parabolic, while we might expect retracements, and just like here where you had this roll back over and come back and test the former area of resistance, now turn support, and that worked, well, we'll certainly have retracements, but they would be expected to be relatively mild retracements before the next bull legs take off. If indeed we are now into a bullish trending market. Now, we're yet to be seen that we're truly in an intermediate term trend with a whole series of higher highs and higher lows, and not just degrading back into another range bound market after making a new incremental high. That's been the nature of the last 2 years. So we're looking to see for evidence of a new nature to the market, but certainly everything is pointing that way thus far. And you see the Dow also really almost parabolic. Obviously, this is not going to be sustainable. We'll have to settle into something that isn't quite such a sharp angle. But that being said, clearly the bullishness has changed its tone of the market. And even with normal retracement, inhale and exhale activity, I would expect that we continue to have bullish action until proven otherwise. Whereas the Russell has recently had a bit of a pullback, but then notice, we had, let's take a look at the rut. Now here on the rut, you have a pattern which could be called an island star. It's a 3 candlestick pattern. Big bullish candle coming into it, then you've got the doji, and then you've got the big bearish candle, which encompasses more than half of the big bullish candle that started the process. So that's a bearish confirmed rollover. That being said, given the strength of the bullishness coming into this, any retracement would be expected to be relatively mild. perhaps come back and test the upper part of the previous channel that we had blown through. At the time, we thought maybe it's an overshoot and it comes back and then comes back into the channel. And then that was promptly answered by the small cap bulls who shot it up and out of that channel in a very big way, but ultimately exhausted into this island pattern. So as to whether we have a few days of weakness or a pause here, and then before we set up the next higher low and the next higher high, I would still expect that the Russell is going to continue this very, very bullish trend. Now, we'll continue to watch, much like with the S&P and the NASDAQ and the others, do we actually get a series of higher highs and higher lows, or do we just regrade after this big blow into a new sideways range-bound market? So we're going to watch what these lows do. Right now, this one's, if it were to turn here, would be clearly much higher than the former low. But we're going to watch this pattern very carefully to see what kind of market tone we're going to get going into 2017. Now, in other markets, of course, crude oil has also had quite a bit of volatility lately, had a really significant area of resistance that it had been fighting with, but then popped and gapped up over that with some of the recent OPEC news, but gave all that back to close actually in a false up day, as it were. It's a red candle, and yet the close is much higher than the prior close, so a false up day. So it looks bearish, and yet it's still bullish, and it's been kind of consolidating from there since. Looks like today may be pulling back to test this former area of resistance. Now should be turned support. It'll be very interesting to see what crude oil does when it gets into that area. Does it indeed support, or does it fall back into the former range? In terms of gold, we've seen gold continue to be weak, and I've had the opinion on this chart that you shouldn't be bullish until proven with a reversal candlestick pattern and confirmation. And this just continues to just be weaker and weaker and weaker, and really no evidence yet that you should be on a different side of that market. Another one not to be on a different side of the market has been bonds. Now, obviously, today will have a very big inflection point on bonds. The expectation, almost universal, is that we will have another quarter-point interest rate increase. Anything that's not that would be the surprise to the market. But there's also going to be market observers that are looking into the nuance of the language around that, nuance around the Fed's interpretation of the health of the broader economy, and then also language around when the next rate increase would be, given that today is an announcement of an increase itself. So all those things could be market movers, and you could have two that come in as expected and one that is perhaps not expected, and that could be the driving force. So a lot of variables that are in play, and there's going to be a lot of people watching the afternoon session of markets today. Take a look at volatility. Volatility is in that what we call bull noise range. Anything between 12 and 15 is generally just noise and a normal bull market, and certainly we're smack in the middle of that. Nothing particularly notable. We've had a little bit of a rise in volatility in recent sessions coming into the FOMC decision, but within the context of very, very, very low starting place. So just kind of noise in the bigger picture would be my suggestion. Okay, on the daily report, we'll continue to see extremely strong bull patterns here, where intermediate term phase opinion is still market phase 4. Price patterns near resistance or extension patterns. In terms of the three market timing signals, the first coming to us from IBD, bullish, confirmed uptrend. The second one, GMI index, a perfect 6 out of 6, very bullish, buy signal since 11:10. And then stock charts, decision point scoreboard has been greatly improved in the last week or two. All the short-term signals are now bullish. Almost all the intermediate term signals are now bullish with 7 out of 8. So we've got a stack that we could call between the two shorter term time frames. We're still waiting for this longer term time frame to start to flip and give us the confirmation of a strong bull, healthy market all the way around. Now, a series of higher highs and higher lows that we were talking about with charts would certainly do that. Position sizing opinions, as you would expect, are still both at 100%. Intermediate term market posture, a severely strong bull across all 4 of the indices, supported by severely strong bullish sentiment lines. So, again, pullbacks are expected to be relatively minor and short in this kind of market posture. Hedge warning status remains 0+, normal with some elevated conditions, but those right now are all fairly minor and becoming more minor all the time. Terms of the 3 strategy opinions, no changes from yesterday. Still giving the opinion that new positions for novice traders are acceptable in the current market condition. A little bit of defensiveness still in covered calls, given how extreme we are in this parabolic move. It's very hard to be adding in when you're this extended. In terms of specific warning areas in the volatility area, we did have that volatility ratio warning fire a couple sessions ago, and this ultimately is just associated with increased volatility heading into the FOMC decision. That 10-day out expected move is still below 40, and this is relatively low-grade warning. Also, distribution day count, NASDAQ still relatively high at a 6, but again, this has been slowly but surely coming down. And then from a trend-based area, everything strongly bullish here. Intermediate risk aversion indicators. We have mixed signals here with not a lot of angle and separation. We'll at this point call this neutral in the overall context. From a sentiment standpoint, we still have on the intermediate term some increased sentiment, and you see the fear and greed index at an 88. We mentioned, I think, earlier this week that anything over a 90 is pretty uncommon. So this is about as extreme as we get. So, something to keep in mind. And certainly when you get this extreme, you start to watch for those reversal patterns like we saw on the Russell. But again, put it in context, very strong bull patterns at this point. So any pullbacks would be expected to be relatively minor from a probability standpoint. From a sector specific, you could see yesterday energy, information tech, consumer discretionary. So 3 of the top 5 were risk on, but also look at who the other players were. Utilities, telecom, and even healthcare and consumer staples, had good days. So it was a mixed day of both risk on and defensive sectors, frankly, doing fairly well. The only negative ones were industrial materials, and they were relatively minor. While a majority of the breadth was negative in those 2 sectors, again, relatively minor pullbacks on a day that was generally positive for most of the market. When you look at market posture across all 3 time frames by sector, it's just about a sea of green, with only healthcare being, the relatively weaker area, but it's also starting to rise along with the tide of everybody else. And you look at the time frame analysis, and 1 day, 5 day, 1 month, 3 month, all out into the year, we're starting to see a sea of green here as well. Healthcare, of course, being the one that's playing most of the catch up at this point. And utilities essentially scratch on the 3-month basis, and consumer staples still showing a little bit of weakness if you go out that far. But look at 1 month. And this is basically just over a month since the election result came in, and look at almost every single sector is not just positive, but is positive by a pretty significant amount. We've had the S&P during this time up right at 8% since the election, which is just over a month ago. So a huge move, inflection point in the market that's now starting to roll and show some real consistency from bullishness from every single time frame. Okay, that should be enough for today. And we're right at 20 minutes, so let's go ahead and roll. I will roll through these slides. If you see something of interest, just hit the pause button and then get the greater details. Also, you'll see a hyperlink that'll take you to even more information. Disclaimers, as always, hit the pause button if you need more time to read the disclaimers. Also note the hyperlink at the bottom for the full set of disclosures. We'll be back here next for tomorrow's session of Falcon Global's market preview. In the meantime, manage that risk profile, and that will help you find the consistency that you're looking for, and then also seek each and every trading session to go out there and learn something about your chosen craft, trading and investing. Good trading.